stop. Before you keep scrolling, I need you to hear something. In 1929, the smartest investors in America were not buying gold. They were not rushing into property. They were not doing anything that would make the front page of any financial newspaper. They were doing something so simple, so boring, so completely unremarkable, that when people found out what it was, they felt cheated. They were holding cash, plain, sitting in an account, earning almost nothing cash. And while everyone around them was doubling their money in the greatest bull market America had ever seen, these people looked like the biggest fools in the room until October 1929. Then they looked like the only people who had understood anything at all. Here is what nobody ever tells you about cash. It is not what you hold when you are scared. It is what you hold when you are certain. And the people who held it before every major crash in modern history were not being conservative. They were loading a gun. This video is about what they knew, that you were never supposed to find out. This pattern has appeared before every major financial collapse in modern history. Before 1929, before 2000, before 2008. The same quiet accumulation, the same boring repositioning, the same move that looked wrong to everyone watching, until suddenly it was the only move that made sense. Most people spend crashes wondering what happened. A small group spends crashes buying everything the panicking majority is desperately selling. The difference between those two groups is not intelligence, not timing, not luck. It is a single decision made months or years before the crash arrived. When to hold cash, how much, and why. I am your host at the Hidden Wealth Archaeologist. We dig through history so you do not repeat it. By the end of this video, you will understand exactly why cash is not what most people think it is, and what the people who survived every crash in modern history understood about it that everyone else missed. Quick pause. Hit subscribe and the bell right now. Every week we excavate a different financial collapse so you see the pattern before it arrives. Now let us dig. Let me take you to a specific moment. New York, summer 1929. A man named Arthur has spent the previous 3 years watching his neighbours get rich. Not rich on paper. Rich in the way that changes how people carry themselves. New cars, new houses, vacations they talk about at dinner parties. His colleague at the firm has made more in 18 months of stock trading than in the previous decade of actual work. Arthur has not participated. Not because he was afraid, not because he did not understand the market. Because Arthur had read something that nobody else at his dinner parties had bothered to read. The actual data behind the celebration. Price to earnings ratios at levels that had no historical precedent. Margin debt, borrowed money used to buy stocks, at $8.5 billion. A number so large, it had never existed before in American financial history. He looked at those numbers and understood one thing with absolute clarity. This does not end gradually. He began converting his modest portfolio to cash. Quietly, a little at a time, moving into short-duration government instruments that yielded almost nothing. His colleagues thought he had lost his nerve. His wife asked gentle questions about whether they were making a mistake. His brother called from Chicago with stories about his latest returns and genuine concern that Arthur was missing the opportunity of a generation. Arthur listened to all of it and kept converting to cash. Here is what makes this so difficult to understand in real time. The market kept rising after Arthur started moving. for months. Every day that passed made his decision look more wrong. Every rising headline made staying in cash feel more like cowardice. Every dinner party conversation about returns felt like confirmation that Arthur had fundamentally misread the situation. This is the mechanism that defeats most people. Not the crash itself. The period before the crash, when everything still looks fine. When the crowd is loudest. When the social pressure to participate is greatest. When staying out feels less like prudence and more like a personal failure. In 2006, the same pressure existed in a different form. Housing prices were rising everywhere. Every conversation at every backyard barbecue involved someone who had made $40,000 on their second property. Banks were lending to everyone. The financial press was writing about a new era of permanent American prosperity. The people who were quietly building cash positions in 2006 were not celebrated. They were questioned. Then something changes. It never announces itself with a headline. It arrives as a whisper, a single bad number, a small crack in something that everyone assumed was structural. October 1929. A Thursday morning. The market opens and something feels different. Prices start falling, then falling faster. Within hours, the calls begin. Margin calls. Brokers demanding cash from investors who bought stocks with borrowed money. Investors who have no cash because everything went into the market. They are forced to sell at whatever price the market is currently offering, which is falling, which forces more selling, which causes more falling. The mechanism that destroyed 10 years of paper wealth in weeks was not the crash itself. It was the absence of cash. At the exact moment, cash was the only thing that could stop the bleeding. Arthur watched from a position of complete stillness. Not because he was cold, because he had prepared for this. He had the one thing that the collapsing system desperately needed, and nobody had: liquidity. Here is the truth that most people never fully understand about cash during a crash. Cash is not a passive asset during a crisis. It is the most aggressive asset available. When markets collapse, sellers need buyers. Buyers need cash. The people who hold cash during maximum fears hold something that the entire system is desperately trying to acquire, which means they can set the terms. Arthur began buying in 1930. The same stocks that cost $100 in July 1929 were available for $11 in 1932. The same companies, the same underlying businesses, the same productive capacity that existed before the crash, available at 11 cents on the dollar. Because the people who owned them needed cash, and Arthur was one of the only people who had any. This is the mechanism the wealthy understand about cash that the financial media consistently fails to explain clearly. Cash before a crash is not a conservative position. It is the most aggressive position available. It just does not look like aggression until the crash arrives and reveals what it actually is: loaded ammunition. Warren Buffett accumulated over $130 billion in treasury bills by mid-2023. The financial press called it excessive conservatism. They said he had missed the rally. They said the old man had lost his edge. He was not being conservative. He was loading the gun. So why do most people get this wrong? Why does the crowd rush into markets right before they collapse and rush out right after? 3 reasons. First, cash feels like a losing position during a bull market, when everything around you is rising and your cash is sitting earning almost nothing. The psychological experience of holding that cash is almost identical to the experience of losing money. The brain registers it as a real loss, and that pain drives people into positions at exactly the wrong time. Second, social proof overrides individual judgment. When everyone around you is getting rich, the biological pressure to participate becomes almost impossible to resist. The brain is wired to find safety in the crowd. During a bubble, the crowd is sprinting toward the cliff, and the wiring that evolved to keep you safe is actively pushing you to follow them. Third, recency bias makes the recent past feel permanent. When markets have risen for 3 years, the brain genuinely struggles to model a different future. The Yale economist who declared stocks had reached a permanent high plateau in October 1929 was not lying. He had simply confused the recent past with the permanent future. These 3 mechanisms combine to ensure that most people are fully invested at market peaks and completely out at market bottoms, every single time. The pattern has repeated without meaningful variation for as long as financial markets have existed. So here is the question that should make you pause. Margin debt near historic highs. Retail investor participation at levels not seen since 1999. Certain asset classes trading at valuations that require assumptions about the future that history has rarely supported. Treasury bill accumulations by major institutional investors, being called excessive conservatism by the same financial press that called Buffett too conservative in 2023. Is the pattern repeating right now? I am not going to tell you it definitely is. Nobody knows timing. Anyone claiming certainty about when is selling something. But here is what I will tell you. The people who have studied enough crashes to recognize the pattern, they are not waiting for certainty before they act. They are building their position during the calm, because they understand that the window to build a cash position closes before the crash announces itself, not after. 4 things the forensic record confirms. Cash before a crash is ammunition, not conservatism. The wealthy do not hold cash because they are scared. They hold it because they understand that crashes require sellers. Sellers require buyers, and buyers require cash. They accumulate the one instrument that cannot be destroyed by the event they are anticipating. The shopping list matters as much as the cash. Arthur did not just hold cash. He knew exactly what he would buy at what price when the moment arrived. Preparation before the crash is what allows confident action during it. Without the list, the cash sits unused while the panic spreads. The social pressure to participate is the signal, not the instruction. When the crowd becomes loudest, when staying out feels most embarrassing, that is precisely when the pattern reader becomes most alert. The intensity of social pressure to participate is inversely correlated with the safety of participation. It always has been. Build your position before you feel the urgency to do so. The urgency arrives after the window has closed. The calm before the storm is the only time the window is open, and it closes faster than anyone comfortable in the calm ever believes possible. Arthur was not a genius. He was not wealthy, not connected, not in possession of information unavailable to anyone else at those dinner parties. He simply understood one thing that the crowd around him had never been taught. Cash is not what you hold when you are afraid. Cash is what you hold when you are certain. Certain that the gap between price and value has grown too wide to hold. Certain that the system built on borrowed confidence will eventually face the moment when confidence is no longer enough. Certain that when that moment arrives, the person holding liquidity will be the only person with options. The crowd around Arthur spent those years building paper wealth they could not hold. Arthur spent those years building the one thing that could not be taken from him by a margin call. When everything crashed, cash became king, and Arthur was already holding the crown. Subscribe to the Hidden Wealth Archaeologist. Every week we excavate a financial collapse, so you see the pattern before it arrives. Hit the bell so you never miss one. Drop it in the comments. Do you currently hold a cash position that feels excessive? Be honest. I read every single one. Cash is not what you hold when you are afraid. It is what you hold when you are ready. Thanks for watching.